I just got off the phone with a business owner client of mine who's about to have a $500,000 tax bill. When you're a business owner, if you have a tax bill that you then put on a payment plan with the ATO, lenders generally won't lend you money if you have an outstanding tax bill that you are paying off. This client was worried that if he gets this massive tax bill and he doesn't have the cash to be able to pay it straight away and puts it on a payment plan, he's not going to be able to go and buy any property. Now, tax for business owners is not due until May of every single year from the previous financial year. So we know that this tax bill is not due until May, and right now he has no tax payable, which means the lenders will look at him favorably. So this is the scenario we built out. I said, before that tax bill is due, let's go and get you another asset so you've got a property that is growing in the market. So we strategized to go and buy a $1.3 million asset before May in his personal capacity, which will be bought inside of a trust for both asset protection and also serviceability protection. He will then have that tax bill payable, and if he can pay it in full, he will, and if he can't, he'll put it on a payment plan, and he'll be leaving no opportunity cost on the table because his max serviceability right now on top of his existing portfolio is $1.3 million. So if he goes and buys that property, then gets the tax bill, then puts it on a payment plan, he can't borrow any more money anyway, even if he pays the tax in full. On top of that, I said, while you are then paying that tax off over the next, say, 6 to 12 months, what does superannuation look like? He tells me, and he said he's got some advice that he could actually go and buy a property inside of your super fund. And I said, great, if I was in your shoes, the cash that you've got sitting in the super fund, if you were to go and invest it in property, you'd be able to buy another probably $1 to $1.5 million asset. And due to super and the way that they look at property inside of super, it's essentially siloed away from your personal capacity. So it doesn't matter that you've got business debt, your personal superannuation is siloed away from that. You won't be able to buy something in your personal capacity, but you will be able to buy something in super. So you could then go buy an asset inside of your super fund, obviously use the cash that you have in there to go buy that asset. Over the next 12 months, while you're paying off your tax, you've then just bought a property in your personal capacity, property in your superannuation, and then once you've paid your tax off and the new financial year is here, profit will likely be much higher in this client's business. He will then have an increased serviceability. The property that he purchases between now and May would have grown in value, and all of a sudden now he's got no tax, equity in the property that he purchased. He can refinance against that with the increased capacity from the profit that his business has generated over the previous 12 months, and then he can go buy another asset. And this is why strategy and planning are so important. Hypothetically speaking, he didn't think about this until after May. The tax bill is due. The tax bill's on a payment plan. He can't then go buy the first asset because he can't get the money from the bank. He can still do the superannuation, but instead of buying 2 assets and growing his wealth significantly, he's only going to be able to buy 1 asset. I'd much rather be in the position to buy 2 assets and then actually be in a position to buy a 3rd asset in 12 months time when the first asset has grown, as opposed to not planning for this and being much further behind. Because if you then project that out over the next 10 or 15 years, the difference in your overall net asset position can be significantly different. And when I talk significantly different, I mean millions and millions of dollars if you're buying assets worth, $1.5 million.